Welcome back. Investors around the world, of course, have reset their assumptions about U.S. economic policy and U.S. economic growth since the election of Donald Trump to a second term as U.S. president earlier this month. Our next guest is a veteran Canadian strategist who believes the fallout to the Canadian economy from some of Trump's policies will be, quote, swift and severe. Let's welcome Royce Mendes, head of macro strategy at Desjardins. Thanks a lot, Royce, for coming in.
My pleasure.
You did say in a fairly recent report that the effects to Canada could be swift and, in a worst-case scenario, could be severe and could usher in a recession. Tell us exactly what you believe.
Yeah, absolutely. I don't think it's any surprise that, given that our largest trading partner has turned so protectionist that in a worst-case scenario, that could mean a recession in Canada. I will say, though, that the good news is that Canadian policymakers seem to be taking a stance that is likely to appease Donald Trump and his administration. What the Canadian government, federal, and some of the provincial governments are saying is that we're willing to work with the U.S. to stop these bad actors around the world who are taking advantage of the North American market. If that works, I actually think that there's some room for optimism here. I mean, the market has moved pretty swiftly to price in a weaker Canadian dollar and a lower path for interest rates here than in the U.S. But if you think about it now, if we can align ourselves more and more with the American administration, maybe leave Mexico out of the equation, sort of paint them as the bad actors here, we might be able to get some sort of a sweetheart deal. Talk
to us more about this idea of Mexico being left out of a bilateral trade agreement between Canada and the U.S. That idea seems to be gaining some traction.
Yeah, I mean, the thesis is that Mexico is basically a dumping ground for Chinese goods. So when there was a diversion in trade away from allowing China to export directly to the North American market, it started to flow into Mexico. And more what American and Canadian policymakers are saying out loud is that Mexico is basically a channel to get Chinese goods into that North American market. If Canada is aligned on this with the U.S., which it seems like they are, we might be able to say, look, we're not the problem here. And when we really aren't the problem here, that we can start to make deals on, let's say, we need to get an exemption on energy. I think that's a clear, that's an obvious example of where the Trump administration is aligned on us. The auto manufacturing sector in Canada and the U.S. is so heavily integrated, that's likely to get an exemption. And if we start to talk about the other sectors in Canada that trade with the U.S., there are going to be interest groups in the U.S. that are going to say, look, we need to give these guys an exemption. And we don't have a huge trade deficit, or the U.S. doesn't have a huge trade deficit with Canada. So why are we penalizing Canada when we should be looking at places like China, Mexico, even maybe the Eurozone as some of the places that America wants to drop the hammer on?
During the first Trump administration, the renegotiations of the NAFTA agreement took so much bandwidth at our government. There's so much energy, so much ministerial time was spent on that. Is that where we're headed again, do you think? Another massive effort to renegotiate a trade agreement?
Unfortunately, I think that is where we're going. It's going to be a lot of noise for the next probably few years trying to get a better deal for Canada. But the strategy is obviously different. In the post-Trump 1.0 election era, what we were trying to do is work with Mexico to strong-arm the U.S. This time around, it seems like we'll try to go it alone. Still means that we're going to lose even more productivity in Canada because all of our government officials are going to be lobbying in the U.S. instead of trying to solve our domestic problems. But it is what it is. This is what the election outcome has been, and we're going to have to devote that important time to getting a better deal for Canada.
In terms of domestic policy, the government of Canada has recently announced, of course, plans to dial back immigration, and you've got some thoughts there on what the economic consequences are.
Yeah, I mean, if you look at it just from a very high level, it's very concerning. I think every business or government official that I speak to is worried about their revenues taking a hit from having fewer people enter the country or potentially an outright reduction in the number of people living in Canada. What I would say is look at the people that are likely to be subtracted. there's going to be a whole lot of students that are going to be subtracted. Those were people that weren't spending a lot. They didn't drive GDP significantly higher when they came into the country, and they're unlikely to be a massive drag on GDP when they're subtracted. They weren't super high productivity. They weren't doing jobs that added a lot to the economic potential of this country. So subtracting people is not the same if you take different demographics of people. So in this case, it's going to be a whole lot of students. It makes me less worried about the economic fallout. It's going to be a drag. Yes, those people were spending on shelter. They were spending on staples in the country. They were probably spending a little bit on other things. But it's not going to be the same as taking the average Canadian consumer out of the Canadian economy. It's going to be less than that. So I think there is, again, some room for optimism versus some of these very pessimistic outlooks that are being published.
What's it mean to the labor market? It wasn't that long ago that it was very common for Canadian employers in many different sectors to say, we can't find the workers we need. And it wasn't just highly skilled workers.
Absolutely.
It was fairly low-skilled work at one point.
Well, the dynamic has completely changed. I mean, the unemployment rate for immigrants who have landed here in the last 5 years is now close to 15%. So that tells you that, there's an abundance of labor in that demographic, which is likely to be the people who are going to have their visas expire and are going to leave. It is going to cause some issues, I'm sure, for some small businesses to try to find labor. But the youth unemployment rate in Canada for all residents of Canada, whether they are recent immigrants or they were born here, is also 15%. So there's some room to pick up some labor from there. So I hope that it's more of an adjustment than an outright negative for companies to try to just resource labor from a different part of the demographic.
Okay, before you go, give us your take on the Canadian dollar. Where is it going over the next 6 to 12 months?
Look, I mean, I think the U.S. dollar has appreciated so much recently. There's room for a pullback there. We're seeing oil prices a little bit higher. As I said, I think some of the pessimism on the Canadian economy is probably a little bit overdone. I think we could see a little bit of strength here in the next 3 to 6 months. But if we start getting slapped with tariffs, then I think towards the end of 2025 into 2026, we could see a weaker Canadian dollar. It all depends on how well our politicians are able to work a deal with the U.S.